Netflix released results after the market closed on Thursday, and everything looked pretty good for the company. Added about 8 million subscribers, which is just an incredible number, even for the company of this scale of Netflix. But the stock is not reacting particularly positively as I'm recording just after the market closed on Friday. Shares closed down 1.5% for the day. So what in the world is going on with Netflix? Is there something fundamentally wrong with the business? I don't think that's the case, but they are building a foundation for future growth. So the story for this quarter is going to be all about advertising. So they're adding a bunch of subscribers, but a lot of those subscribers are on the advertising supported side of the business. That's not something Netflix has done at all throughout its history. It is building out its own technology. So this should be a pretty good business for them long term, but it's not the driver of the business right now for them. So that is impacting their financials. So I'm going to go through some of those details and how it might relate to Disney when it reports a few weeks from now. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the numbers from Netflix. These are the high level numbers from Netflix. This is always the first thing that they show in their earnings report. So you can see $9.559 billion worth of revenue, up 16.8% from a year ago, but you can see that that growth rate has really slowed over the last quarter. The sequential growth rate is just 2%. So I'll get to what exactly that means in just a second. This was the membership growth number that I highlighted earlier, 277.65 million members, up from 269.6 a year ago. This is part because of their crackdown on password sharing. So people are going to either have to cancel Netflix or basically pay for it. And it looks like a lot of people are deciding to pay for Netflix. But what's interesting in these numbers is if you just divide revenue by the number of subscribers and then divide by 3 months and a quarter, the average revenue per subscriber has fallen from $11.59 per month to $11.48 per month. So that revenue per subscriber is going down. That is in part because they're adding a lot of advertising supported subscriptions. Ad tier memberships grew 34% in the quarter, and they are now building in-house ad tech platform that they will be testing in Canada in 2024 and much more broadly in 2025. Now you can see from the growth rate, management is expecting growth of about 14% for the year, that they're expecting that revenue growth to decline a little bit in the second half of the year. So down to 13.9% next quarter, should be a little bit lower than that following quarter. The other thing that I always think is interesting with Netflix is looking at this share of US TV screen time. You can see that broadcast TV still generating about 20.5% of screen time, cable 27.2%. So add those two together, that would basically be the cable. That would basically be the traditional cable bundle still generating more screen time than streaming is. Within this streaming segment, you have YouTube leading the way. That's always something that I think we overlook as investors, just how massive YouTube is. This is one of the reasons I own shares of Alphabet. Netflix is number 2 with 8.4%. Number 3 is actually the combination of Hulu and Disney Plus. One of the things they don't show here is ESPN Plus. Not a big service on its own right now, but they are going to have ESPN over the top. So that will be added to this under the Disney platform. So Disney is actually going to be in the second place with 5.1% market share of US screen time from a streaming perspective. So Netflix obviously doing very well, but I think the upside is potentially with Disney because Disney is in the number 2 spot and gaining share. They already have that ad-supported platform built out. Hulu has been serving ads for years, and they're now bundling with more and more services. So we'll see what those numbers look like from Disney, but I think that's one that when I look at Netflix's results, I think it lends itself really well to what Disney is going to report in a couple of weeks. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, I think some of what we're seeing with Netflix is the natural evolution from a premium only, no ads subscription. They were actually the two levers that they could really use to increase their revenue was increasing the number of subscribers. You kind of reach a limit there eventually once you're over 250 million subscribers. So the other lever you can pull is increasing prices. Netflix has done that pretty aggressively over the last few years. But as you increase prices, you make your offering less attractive to a certain cohort of users. That cohort makes more sense for an ad-supported product. That's going to be a lower price point. Eventually, you'll be able to make that up by those advertisements making up the delta, or maybe even more than the delta, between the ad-supported subscription price and the no ad subscription price. The challenge for Netflix right now is they're adding subscribers to that ad supported tier, but they haven't yet monetized in the same way that they do on those premium tiers. And so that will change over time. That's why taking this advertising business in-house is the right thing to do. I think they will be able to monetize that extremely well. YouTube has built a massive business almost entirely on an ad-supported platform, but advertising is also what Alphabet and Google does really well. Now, as it relates to Disney, what I think is interesting from the success that Netflix has had bringing in ad-supported users is that Disney is offering compelling prices from those ad-supported tiers for both Disney Plus and then also bundles with Hulu and ESPN Plus, likely to be ESPN over the top sometime in 2025. I think all indications are they have a much more mature advertising business as well that was built in-house and was acquired from Hulu. You also have the ties to their traditional media business. So if they're able to add more ad-supported subscribers in 2024, maybe not 8 million in a quarter, but even just 4 or 5 million would be a solid move in the right direction for Disney. They could potentially monetize those users a little bit better than Netflix is currently doing, maybe not giving up on the average revenue per user in the way that Netflix appeared to have in the most recent quarter. But what I think is absolutely clear is that both Netflix and Disney are separating themselves from the field in the streaming business. They're the two companies that have the most scale. They're the two companies that have arguably the best assets and the best content on their platform. So if you think about this in a concept that I like to call the smiling curve, they are the companies that are winning on scale. YouTube is on the other side. YouTube is for small creators like myself. You're not going to find blockbuster movies on YouTube, but you are going to find hundreds of thousands of very small creators. So they're going to be more that niche business and connecting those creators with a billion person plus audience. So that's why the value ends up in those two ends of the curve. The companies that you don't want to be are some of those companies that were highlighted in that streaming image. Paramount Plus, Peacock, having about 1% share. Max is only 1.4% share. Even Roku, even the Roku channel is only 1.5%. So all of those streaming services are much lower on the scale level. They're not going to be able to acquire as much content. They're not going to be able to monetize as well. So I think if you're into streaming right now, the two stocks you want to be looking at is Netflix and Disney. My argument against Netflix is just simply price. Trading for 44 times trailing earnings and 33 times forward earnings. That's for a company that's expecting to grow a little bit slower in the second half of this year. Long term, wouldn't be surprised if we're going to be more like a high single digit, low double digit growth rate, not the kind of growth rate you would expect for a multiple like that. But we'll see where things go. Strategically, they're absolutely in a phenomenal position. The question for investors is just, is it the right price? For me, it's not the right price right now, but that's why I'm investing in Disney, because I think the upside from an investment perspective is with Disney. So we'll see what their streaming numbers look like and how well they compare to Netflix, especially on a monetization level. But let me know what you think of Netflix's results. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.